This is Scott Becker with the Becker Private Equity and Business Podcast. We generally have short business episodes, short private equity episodes. Then we have some longer interview episodes like the one we were with today. Today we're talking to Rick Kes. Rick is one of the most listened to guests on the Becker Private Equity and Business Podcast, recently ranked #1 in the country in Apple Business News. So thrilled for that. We're going to talk to Rick about a few trends in the private equity deal world. And Rick, I'll start with two sort of observations. First, this past week was one of the biggest weeks in a very long time in terms of private equity deals announced. Something like $30 billion in deals announced, which seems like a long time coming. The year as a whole is still well short of 2021. 2022 and 23 were way down from 21. So there's that one issue. And then there's also this week the Price Waterhouse mid-year private equity report, where they talk about 27,000 companies seeking exits. And so talk about these things. $30 billion in deals announced this past week. Are we seeing a return to a deal time? What are you seeing out there? And then also the concept that Price Waterhouse noted in their mid-year report, 27,000 companies seeking exits or looking for exits. What are some of your thoughts? What are you seeing out there?
Yeah, no, I mean, I think it's interesting. I mean, I think if you take a look at, what PwC's report is kind of suggesting, and kind of where we all had our mindset, kind of thinking, hey, at some point, those 21 transactions that occurred in 2021, that is, at some point, those deals are going to be ready to flip. And the ones that were probably ready to be flipped in 22 and 23 and 24 so far that have been waiting, for interest rates to go down or waiting for some other thing to happen, all those, transactions have to move at some point. And I think what we're kind of seeing here today, I think, is a little bit of, okay, interest rates might not change all that much. They might go down, hopefully, in the last part of this year at some level, but not dramatic enough to maybe make a huge difference in the actual activity or economics of a transaction. But, we got to kind of put that on the sideline and just move forward with what our plans are as it relates to making transactions that, we're kind of on the deal docket, so to speak. So I do think just kind of where we sit today, given dry powder that's out there, some of the pent up transaction activity that should have occurred, in the last couple of years that hadn't, I do think, all those things are kind of pushing people to maybe change some of their expectations around deal price. Maybe sellers taking down their expectations a little bit, where some of these transactions can start to now be kind of thought through, because where the economic transactions we're gonna kind of pop out. So I do think because of all those things, we will start to see some transaction and volume activity occur, albeit probably not at the prices that some of the sellers were hoping for previously, but yet still hopefully accretive to their overall mission of growing, value for their LPs.
Rick, we constantly see reports of there's this mismatch between pricing and valuations between buyers and sellers. Are we getting closer to a spot where sellers will take a little bit of not a discount, but not be as aggressive about pricing because funds want to get out of these deals and move forward with their portfolios? Is there starting to be some of that temperature or not really?
Well, I think sellers that, are kind of getting to the point where, whether it just be the stage that they're in their investment cycle, are going to have to start to think about, hey, maybe we thought we had a certain multiple, and now we're going to have to change that expectations a little bit, because, the buyers out there that are going to finance these transactions using debt just can't make the deal work, with the price where we thought it was going to be at in a zero interest rate environment or near zero interest rate environment. So, yeah, I do think that pendulum will be forced to change slightly, or other things within the deal structure to make it more buyer friendly than perhaps what we would have seen in 2021 or 2022, where interest rates were, all be it, relatively close to zero. So that's where I think we'll have to figure out, from a seller perspective, what things are we willing to do to maybe either reduce our expectation on price, or change the deal economics so that maybe we're taking more risk post transaction, maybe longer run out periods, maybe more rollover equity, things of that nature, so that we can make these deals work, both on both sides, both the seller and the buyer, in the new reality of the new interest rate environment that we're in.
Thank you. And are you starting to get the feel? I mean, you're at one of the biggest firms in the world. I think the fifth largest accounting firm in the world. Also the from a consulting firm, the number one leader sort of in this private equity world. Are you starting to see more discussions of deals? What are you feeling over there? Just a general sense. Obviously, you can't share internal guidance, stuff like that. But what are you feeling? Are you seeing more of the deal environment pick up?
Yeah, I mean, I think one of the alternative data sources that I usually use is just, kind of where our transaction advisory team is in terms of percentage utilized, and how many people are sitting on the bench. And we're still super busy, which is interesting to me given the deal environment that we're in. I mean, obviously we were busier in 21 than we are today in terms of deals that we're working on, but we're still really active. So I think, there's still a lot of sell side opportunities coming in the door, which obviously have, kind of, when we get engaged on a sell side engagement, usually that means that something's coming down the pipe, maybe 6 to 8 months down the road. These transactions kind of take a while to go through that process. So, given that, I think, we continue to be, favorable in terms of our outlook, in terms of deal activity, but yet I think some of that is optimism as well. So, I think, like I said, our deal advisory team is still very busy, still working on deals, still getting sell side opportunities in the door. And then obviously, those will start to turn into and flip to buy side opportunities for, other firms, and then, vice versa for us. So I do think we'll start to see some activity, over the next, 3 to 6 months in terms of deal flow. The other thing that I'm always curious about in terms of, what might impact the deal environment will be, strategic investors, and their capabilities of coming in and buying some of these assets that are on the sale block, as well as, just overall how much of the deal flow activity that you referenced before was, one or two very large deals that kind of create this disruption in the data set, whether you're looking at deal volume or deal activity. I think the number of deals is almost as important to a firm like us as the deal value, which obviously is important to other people as well. But, the number of transactions really fuels a lot of that, appetite for a firm like RSM or other firms that are providing services to these, private equity groups and the portfolio companies that they represent.
Rick, let me ask you this question. Anything else that you're sort of most focused on and excited about at this current moment as we head towards the second half of the year?
Yeah, I mean, obviously, we're still hopeful, related to interest rates, and what we'll see from the Fed on that perspective. I think as we continue to move through the summer, obviously different things will impact, the Fed's decision making related to to interest rate environments and changes that they may make there, which will obviously have impacts to our clients. But, I think, what I'm continuing to really coach our clients around is, making your assets as, efficient and productive and buyer, accretive as possible. So, really looking at the operations of our clients and trying to help them become, better companies so that they're better assets when they go to market and can, overcome some of the price reductions that they might be kind of forced to take by being able to say, well, yeah, the interest rate environment is higher today than it was in 2021, but our business is a much better business than it was in 2021. And perhaps being able to, kind of pull both levers, one way and one the other way by saying, well, net, maybe our business is still valued where we think it should be, albeit, because it's just operating so much more effectively than it was. But, we did have to take some consolation on the interest rate environment that we have. So I do think that's really where our clients are really focused on, is trying to make their assets as attractive as possible, on all things that they can control. Obviously, they don't have a whole lot of control in the interest rate environment, but they can control how effective their business is at kind of creating value and revenue growth and, those types of things.
Thank you, Rick. I want to thank you for joining us on the Becker Private Equity and Business Podcast. Again, Rick Kes, brilliant partner at RSM. Thank you for sharing your thoughts regularly with us on the Becker Private Equity and Business Podcast.
Of course. Thanks for having me, Scott.